Robert, thank you very much for joining us today. How are things in Toronto?
Things are great. Nice weather, baseball. Nothing to complain about there. How are you, Jimmy?
Yes, beautiful weather. I love this time of year. So, even though the sun is shining in Toronto, things are not that well in the Canadian economy. And this is what I want to discuss with you today. One of the things I try to do on this channel, Robert, is to educate people on the Canadian economy, the US economy, the global economy, and just help people navigate during these uncertain times. And you and your team at Rosenberg Research have done extensive research on the Canadian and US economies. And this is where I want to focus our discussion today. The last few years have gone, you can say Canada's gone through some economic upheaval. The unemployment rate across the country is at 7%. In the province of Ontario, where you and I reside, it's at 7.9%. And in the city of Toronto, it's 9.9%, which is a shocking number. And when I look at these numbers, it's just, I'm somewhat astounded as to what's happening here. So maybe we can just start right there. What is happening with the Canadian economy? Why are our unemployment numbers so high?
So Canada has two economic problems that are happening at the same time. We have what I call a structural problem and a cyclical problem. So structural problem meaning our growth rates on average have just been falling for several years. Even when everything's going well and the economy is growing at potential, because of low productivity growth, low R&D, low capital formation, our economy just isn't typically growing that quickly. But then also on top of that, this year, we're even below what you would expect from sort of potential growth or structural growth. And that's because of a combination of uncertainty and tariffs having a huge effect across the Canadian economy, but also the effect of low oil prices. And so you add that together, the economy has not been growing quickly enough to keep pace with the expanding labor force. And when that happens, you're going to see unemployment ticking up, up, up. So unemployment is up about zero point 0.4 percentage points nationally, but as you say, in Toronto, it's more like a point and a half. And we can talk about young workers, in the more vulnerable sectors of the labor market, you see that effect much more clearly.
So just to clarify what we're seeing right now, even though 2025, there's been a lot of uncertainty with the trade wars and tariffs, et cetera, with the US, but these problems have been in place now for many years. Is that correct?
Absolutely. That's right. So you can think of the sort of potential growth rate for Canada around maybe 1.8%. That would be sort of everything going as you would expect of a long run average. And that's already on the low side, right? But this year so far, if you look at the monthly industry GDP data, we've seen around a 0.7% annualized growth rate in GDP. So we're even well below what was already a pretty low potential growth rate.
0.7%, that's an annualized number.
That's an annualized number, yeah. So
Uh,
that's
and,
that's
and
quite
so
low.
we're pretty
That's
close to
stall speed,
going
right?
negative. Like, do you see Canada going into a recession, or are we already in a recession right now?
We are flirting with the line, right? If you look at the employment growth number, the last employment report that we got actually showed a very large rebound. But the 2 months before that were very bad. So we lost about 100,000 jobs in 2 months and then gained about 60,000 back. Now, that's still the worst combined 3 month performance since the pandemic. There's a huge amount of volatility in this data. We're going to get new industry jobs data later this week and GDP data later this week. So hopefully that'll shed some new light on it. But as volatile as the month to month numbers have been, and we've had a few really good months this year, sprinkled among the bad, but the trend line's been quite bad this year.
So I have a couple of kids that are in university and they're going to be entering the job market soon. And they're both very concerned about finding a job. And I wasn't aware of this, but they told me that the youth unemployment rate in Canada is at 14.7%. I was shocked when I heard that and I looked it up. Sure enough, hasn't been this high since the 1990s. What is happening with youth unemployment? Why is it so high?
Well, in the last 3 years, employers are behaving in what I would call a really defensive way, which is they aren't engaging in layoffs. We're not seeing a huge spike in layoffs, which is the sort of more traditional way that the unemployment rate would go up. We're just seeing a large pullback in hiring. And that's what companies do when there's uncertainty. They're not sure about the future. What they don't want to do is hire a bunch of people and then have to fire them 6 months later because that's very costly. So they're just waiting. But what that means is the pace of hiring every month, you have new graduates coming in, new immigrants coming in, regular turnover of jobs, and the jobs just aren't there for people. And so the number of unemployed people in Canada keeps ticking up and up and up. And of course, if you're a young person who's trying to get on the job ladder, you can't just not quit your job. You don't have a job at all. And so that's why youth unemployment is sort of the canary in the coal mine for this. That's where you'll see this defensive corporate behavior first showing up.
So it sounds like you're telling me my kids are going to be living in my basement until they're in their 30s.
At least for the next 6 months, they'll be living in your basement. Yeah.
Well, they're still in university, so okay, we got to talk about. I want to stay on the topic of unemployment, and we got to talk about the auto industry in Southern Ontario, and it's a very important sector. Uh, when you talk about auto assembly, it employs 45,000 people, and then when you add in autos, trucks, and supply chain, the entire supply chain, you're looking at 150 to 160,000 people just in Southern Ontario. It's a big number. Stellantis, one of the largest automakers in the world, announced it's shutting down an assembly plant in Brampton and moving the jobs to the state of Illinois. And in addition to that, they're going to be spending $13 billion dollars in Illinois over the next 4 years. They're going to create 5,000 jobs. The province of Ontario will be losing 3,000 jobs. General Motors also just announced that they're shutting down a plant in, I think it's called Ingersoll, but they make one of these EV vans there. I don't know if you've seen these. They were hoping to sell these to UPS, FedEx, and Amazon, but turned out to be a big bust. Nobody's buying them. So they're shutting down that plant. That's 1,300 workers. Things don't look good here in Southern Ontario, especially in the auto sector. Where do you see the unemployment rate going? If it's at 7.9 or 8% right now, I'm sure you have some projections on how bad things will get, not only in Ontario, but in Canada.
It's worth noting that, as you say, auto industry employment all in somewhere around 150, 160K. If you look at what's happened so far, we've only actually lost about 5,000 jobs in that sector so far this year. But everybody expects these bigger job losses to come, right? It's sort of the layoffs, the closures haven't happened. And the risk is more intangible, right? If you want a scary story, take a look at the Australian auto sector, right? Australia used to have an ecosystem of car manufacturers and car parts manufacturers. There's sort of a necessary minimum scale. It's hard to have just one company in isolation, right? You sort of need a sector or an ecosystem. Well, over time in Australia, these companies closed and closed and closed, and gradually the whole sector shrank away almost to nothing. So I think the fear isn't, oh, we're going to lose 1,300 jobs out of 130, 150,000. That's only 1%. That doesn't sound so bad. The fear is you get a critical mass of closures and you lose half the industry in 5 years, right? And so we have to think strategically, and we have to think about how can Canada have a viable auto sector in a world where we have U.S. auto tariffs? Is that even possible? Because it doesn't look to me like these auto tariffs are going anywhere. Um, but in terms of, here's the good news, it is still a relatively small sector from the point of view of Canada as a whole, right? And so it's concentrated very regionally in a particular part of Ontario. But the unemployment slowdown in Canada is much more a consequence of these broader economy-wide trends than just being auto and steel. It's about the whole economy.
So let's talk about that. And you touched on foreign direct investment earlier, or FDI. I keep hearing that foreigners or foreign companies are not investing in Canada because it's uninvestable, because of the policies put forth by the Liberal government in the last 10 years. Maybe you can just speak to that. What exactly is foreign direct investment, and is it weak, as we're led to believe, or as I keep hearing?
Well, there's direct investment in both directions, right? There's Canadian companies building plants in other countries, and then there are foreign companies building plants in Canada. And typically in the Canadian economy over the last 3, 4 years, Canadian direct investment abroad has been larger than inbound direct investment, and actually that's not always true. But that's typically been true on average. So it's not so much that we're seeing a large reduction in um, direct investment into Canada yet. It's more that, again, we're seeing announcements of that potentially being about to happen, right? You gave your auto sector examples, and we're seeing lots of other potential things. So, we only have the data up to the second quarter of 2025. I bet you in Q3 and Q4 and Q1 of next year, then we are going to start to see a meaningful slowdown in FDI into Canada, but it hasn't quite happened yet.
One of the things that confounds me about what's happening here is that we share a border with the world's largest economy, the US, and it seems to be doing very well. The GDP continues to grow at 2.5 or 3%. Unemployment is still relatively low at around the 4% level, which historically is a low number. The S&P and the Nasdaq continue to make new highs every other day. Why are we not benefiting from this relationship? I mean, you talked about a few of the things earlier that our growth rates are down, productivity levels are down, but I still don't understand. Like I can understand this year in 2025. Okay, there's a lot of uncertainty associated with the trade situation, but in the last 5 or 10 years, why haven't we benefited from the growth that the U.S. has seen?
Uh, we certainly have to some extent. One of the interesting things that we've seen in the last year in these US growth numbers is how narrow American economic growth is, which is so much of it is concentrated in AI related capital expenditure. And by some measures, that's providing more growth than the entire US consumer sector, if you just think about it in terms of contributions. So the problem for Canada is we export a lot of stuff, but that's not really the stuff we're exporting, right? We're not exporting a lot of semiconductors and chips and that part of the value chain. A lot of what we export are commodities. And you look at energy prices, they're very depressed right now. You look at a lot of other commodity prices are, you know, maybe slightly above average, but we're not seeing a huge boom. And so that would be, and of course, other things that we export are auto and steel, and those have tariffs right now. And so the problem is basically the things Canada is exporting are not necessarily the things that are booming in the United States right now.
So something else we got to discuss is inflation. And I would think in a slowing economy, prices would be coming down, but that's not what I see, especially when it comes to food. And like I can't believe every time I go to Costco or Walmart, I used to drop $500. Now it's $1,000. And I was at a butcher shop this past weekend. And for the most part, when I go buy my groceries, I really don't know the prices, what I'm paying for things, right? Like if it's bananas or apples or whatever it is. But the one thing I always notice is beef tenderloin. And I think it's only because I buy it at special times because it's so damn expensive. But I was shocked. It was $52 a pound. And that's up from $4 a pound, like not even a month ago. And early 2020, before all the craziness started, it probably used to go for 25 or $30 a pound, depending on what store you go to. What's happening with inflation in this country? Because to me, it just looks like it's never ending.
Well, you should be wary of going by the grocery store test because, of course, food is one of the small part of the basket and is maybe the most volatile part. But you're not wrong. Inflation is persistently above the bank's 2% target and has been since 2022, late 2021. However, there is a clear disinflationary trend. It's been volatile. It's been a little slower than we've expected, but key the key connection between what we were talking about earlier and the inflation numbers is that when unemployment is this high, 7.1%, well above what we call the neutral rate, that means there's a lot of slack in the labor market, and that's going to tend to be reducing the pace of wage growth. And when it reduces the pace of wage growth, it will eventually reduce the pace of service sector inflation. It's just that that happens on a 6 to 12 month lag, right? And the other big component of inflation is shelter. We're seeing falling rents and falling house prices. And so there's a lot of predictable disinflation baked into the data that's going to start hitting in 2026. So that's why. So we're taping this on a Monday. The Bank of Canada meeting is in 2 days. Markets are pricing around an 80 to 85% chance of a cut. And the reason for that is the Bank of Canada knows everything I just said, right? They're looking at this very soft labor market. So they're saying to themselves, well, inflation's not going to go up. Inflation's got nowhere to go but down. And so, as frustrating as the trends over the last couple of years are, um, we do see this as a problem that's headed in the right direction.
And you bring up a very good point. The Bank of Canada has been very aggressive in cutting rates. And in 2025, 1 million mortgages were coming up for renewal. 2026, I believe the number's around 1.2 million. So they realize like anybody who bought a home back in 2020, 21, their mortgage payments are going to take a big bump here with these higher interest rates. Do you think they're trying to get ahead of the curve here and they realize there could be a real storm on the horizon, especially when it comes to the real estate market?
Yeah, I mean, in a sense, the economic slowdown is coming at the right time for dealing with this mortgage renewal cliff. And absolutely, I mean, if you read the Bank of Canada's research papers, this is something they're very much aware of. They know about this renewal cliff. But it's just one of many factors that they're juggling. I don't think you have to. I don't actually think their rate cutting cycle would be very different if that problem didn't exist based on what they've been doing. It's overwhelmingly driven by the stickiness in inflation balanced against the weakness in the labor market.
Just because we're on the topic of real estate and also inflation, in the city of Toronto, the property taxes went up 6.9% in 2025. That's up about 25% in the last 5 years, which is a crazy number. But a month after they put up the property taxes, the city councilors gave themselves a raise of 24%. So their annual salary went from $137,000 to $170,000. Is that
Yeah.
crazy or what?
Well, the property taxes is partly a reaction to the fact that many parts of the residential property tax base in Toronto are declining in value. So to some extent, they're raising taxes on a shrinking base just to get the same revenue numbers. Um, and we think that there's a fair amount of price correction to come in a lot of aspects of the condo market in particular. So, but again, the sort of tax planners, they know that, and that's part of the reason why I wouldn't be surprised to see another property tax increase next year, just out of mathematical necessity, based on the underlying trends.
Oh man, nothing but positive news from you. You bring up an interesting point about the tax base because in the town where GM is shutting down that plant that employs, I think, 1,300 people, well, 12% of that town's tax base comes from General Motors. So it's going to have a significant impact on what's happening there.
Right. So all these industries, one of the reasons why the auto sector is sort of top of mind is precisely that it's so concentrated, right? It's not like every town has 1,000 auto sector jobs. It's that there are some regions of the country that could be completely wiped out by the closure of some of these plants, right? And so that's why both the federal and the provincial governments are investing so much time in this. I expect in the coming federal budget, should be next week sometime. You'll see some money for the auto sector and retraining and those kinds of things.
So we talked about the Canadian economy and how weak it's been. And one of the other things that confounds me is when I look at the Toronto Stock Exchange or the TSX, it's doing very well. It's trading at or near all-time highs. The Canadian banks are doing very well. A few of them are trading at or near all-time highs. And yet, when I look at the stock market, it's a discounting mechanism for the economy. And yet, here we are, the market's making new all-time highs. How do you reconcile that? We have a weakening economy, but yet, when you look at the TSX and its performance, it's doing quite well.
Well, the stock market and the economy are not exactly the same thing, and that divergence has been widening over the last several years. So that happens for a couple of reasons. Reason one is the composition of the TSX is very international. It's exposed to a lot of things outside of just the Canadian economy. Um, Even though Canada's economy hasn't necessarily benefited from the US boom. There are select Canadian companies in the index which are benefiting from it. And Canadian corporate profits have held up better than GDP. And so we've seen this divergence between capital and labor in their divided fortunes, right? Companies are able to, they're holding off on hiring, which will tend to reduce unemployment, but that can be a support to profits, at least in the short run, if they're doing more with the same number of employees. So that's part of it. And the other thing that's been supporting the TSX is, of course, that the Bank of Canada's in an easing cycle, right? And there's this tendency, both the Fed and most global central banks are all cutting rates. So that's going to tend to support equities because you're lowering the discount rate. So the TSX has outperformed many indices so far this year. It's been a real success story. Also, a few other specific factors, which is the soaring price of gold because of all the uncertainty. That's been a contributor. I forget the exact number, but I believe it's at least 5 percentage points of contribution of the index are from gold stocks alone, which have had such a huge run up, right? And so that's just another sort of idiosyncratic factor. So you add all that up. The bottom line is it doesn't mean the economy is doing well. It's for all these sort of other factors.
And when you look at the Canadian economy, we already discussed how weak it is. You said it's if it's not in a recession right now, it's going to be going into a recession.
I think I
Um,
said flirting,
Flirting with a
flirting with a
recession.
recession.
Okay. And I can only imagine with the all the what's happening within Southern Ontario and the auto sectors and all the uncertainty still associated with the trade wars, we're going to be in a recession, if not in Q4 or Q1 for sure. But how bad do you think things get in 2026, especially if this whole trade war situation continues to be unresolved?
The most important thing for the Canadian economic outlook is what we're doing with CUSMA renegotiation, right? Literally, that's the largest factor by far. And I think that in a scenario where we get CUSMA renegotiated, it's important to understand that Canada's effective tariff rate, we have all these bad headlines about steel and autos, but we're actually in a much better place than the EU and Japan and some of these other countries that are facing 15 or, even some Asian countries close to 20% effective tariff rate. Ours is more like 5 to 8%, depending on how you slice it. So if we get CUSMA renegotiated, and if, as I suspect, the federal liberals turn on the taps a little bit in their coming budget and add 10 or 15 billion dollars more in additional spending and maybe some subsidies to businesses, that scenario is the scenario where we avoid a recession. I would still expect slow growth because of the uncertainty, but that's why I say a recession isn't necessarily certain. A combination of CUSMA renegotiation and federal stimulus and one or two more Bank of Canada rate cuts. And if oil goes back, stays in the high 60s instead of the high 50s, all of that together should avoid a recession, right? You're still looking at only 1% growth. I think you would still see increasing unemployment because we wouldn't be keeping pace with what would be needed. But that's my base case is just barely avoiding a recession because of that combination of factors. So then there's the other case, which is suppose we don't get CUSMA renegotiation and our effective tariff rate goes to 15 or 20%, the same as all the other countries. Then you're going to have a recession. Then it's unavoidable. You would have a large, deep, cross-sector structural recession that'd be very bad. Unemployment would easily go to 8.5 or 9%, if not higher. And all the federal spending in the world isn't going to stop that.
And oh boy, nothing but good news from you. So the last severe recession we had in Canada was the early 1990s, and I can't remember what the unemployment rate was, but I'm sure it was double digits.
Yeah.
And I don't even know what the circumstances were that resulted in that. But do you see that same sort of thing happening again? I mean, we
Uh,
already have youth unemployment at call it 15%. We haven't seen those numbers since the 1990s.
yeah,
Is it going
we
to
could
be, when you talk
potentially
about
we
this worst case scenario, can it be as bad as the recession we saw in the early 1990s?
absolutely, it depends on how high the tariff rates go. But if Donald Trump wakes up one morning and decides to impose massive tariffs on every part of the Canadian economy, yeah, you could get an early 90s recession pretty easily. And I think in that scenario, it would be accompanied by pretty deep house price declines in a lot of these, a lot of asset price declines, probably a stock market decline. So that's something to keep an eye on. I think my advice to people is if you're an investor, you look at how rich the TSX is right now. This is a really good time to take some risk off the table, right? I'm not saying sell everything, but this is a good time to de-risk the portfolio, shift out of stocks into bonds, maybe outside of Canadian equities, maybe buy more Asian equities, some emerging market equities, have some diversification in the portfolio because these worst case scenarios do happen.
Well, that was a great discussion, Robert, and I want to thank you very much for spending time with us today. And a lot of what we discussed is not too positive. I always like to finish on a upbeat note or a more positive note. And the one thing we really have going for us right now are the Toronto Blue Jays. And it doesn't matter if you're on the West Coast or the East Coast or somewhere in between, or if you're conservative or a bleeding heart liberal, we're all cheering for the Toronto Blue Jays. So go Jays.
Go Jays. Thanks, Jim.
And Robert, if somebody would like to learn more about you and your team at Rosenberg Research or check out some of your products that you offer, where can they go?
They can go to rosenbergresearch.com and they can request a free trial of our research, and you get access to all of our macro data commentary, all of our market strategy, our thematic research, and our special reports. So by all means, sign up, and our sales teams will reach out.
Robert, once again, thank you.
Thanks.